Okay, good evening, everyone. We are now on week number 8 of our course, and then we're going to chapter number 12, which is capital budgeting. So last week we talked about cost of capital. What we learned on cost of capital is that it is you use both the cost of debt and the cost of equity. When you combine, is the weighted average cost of capital, and that weighted average cost of capital is synonymous to the hurdle rate or the discount rate. Now, knowing that rate, we will be using it to benchmark and identify which project, if you actually look at a series of projects on the company, what's a good project to invest on. So let me place the case study now, or our example later on. You, as a future CFO, a chief financial officer, will be managing projects. Your goal is to increase profitability by creating assets or investing on assets that would generate future cash growth. What do we mean by that? I would invest on new projects that would build a new warehouse, build a new store, invest on machinery, because over time, those assets will be generating profit for the company. That's your goal, right? To expand the business. Now, the question is, as a CFO, you have finite resources. You only have this much cash, and then you are only able to work on certain number of projects to invest on. So which project would you need to invest or prioritize? So do you say project A, project B, project C? I'll take, but not D, E, F, or I will take only E and B and C, but not everybody else. So how do you do that on a quantitative side? So that's why we're going to be going through certain calculations, right? That is basically capital budgeting. Capital budgeting, you're allocating the capital to certain projects that are profitable for the company. That's why it's called a capital budgeting decision. I'll go through the slides. So capital budgeting is a decision-making process that involves planning for the expenditure, capital expenditure or CapEx, for projects within a minimum period of 1 year or longer. And then capital expenditure requires planning, product design, maybe some assets if you need, capital market, and then things that in that nature, right? So for the work that I do, I'm part of the business planning department. And then, so for example, I mentioned before that I work for the fuel company. So the question is, if I need to create the only way to grow is to increase the volume of the number of gallons that we sell every year. If we have maximized our sites at the gasoline station, either we expand the gasoline station so we can serve more vehicles, or we create new retail sites, maybe construct a new retail store so we can gas more, right? And then if we say that, okay, in Guam, what about location A, B, C? Which one is profitable if we only have one station to establish, because that's our only budget? Now we actually take a look at it like, okay, which one would actually provide the highest return? And then the way that we look at it is actually what I'm going to show you. We look at the net present value. So we look at the NPV. We take a look at the IRR, the internal rate of return. And also we look at the payback period. So the net present value, NPV. So I might use some acronyms, but bear with me. Internal rate of return. Oops. Or IRR, and the payback period. Okay, so those are the things that we actually compute. Now, when you look at this one, we're going to go through a calculation, and then I'm going to go back to the PowerPoint slide for some theory behind, right? So I'm going to go to the calculation. The calculation that I'm going to show you is similar to what you have on your book if you read the book. It's just that the book does not have any Excel file that comes with it. So I need to always create it, and I need to put my own twist so it's easy for you to work on it. So hopefully you find it helpful in studying the chapters using the Excel files that we attach on each of the week, right? So I'll move on that Excel file. Okay, so I'm going to make sure that we navigate the Excel file first, right? So on our Excel file, we have a couple of tabs. So I have a cash flow tab on the bottom side here. And then I have a net present value, an IRR, and a modified IRR. So that's the calculation that we're going to do. Then after that one, we're going to show you the back on the theory side. Okay. So this might be a two video presentation for this week. I have also on the same tabs a take note in dark blue and a core learning. And later on, you will see also here definitions on the other tabs. So I want to make sure that you can use that and then your eyes are drawn on that one, right? And of course, we have like the boxes. Okay, so let me click that. So for now, we are doing a capital budgeting decision. And then remember on week number one, we talked about revenue is sanity, net income is vanity, and then cash is king, right? Revenue is vanity. Let me just make sure I have that. Net income is sanity, but cash is king. So this is actually what we've been looking at as a guide, right? For the past few weeks that we've been talking, and then I'm gonna highlight this one. So the reason why is that uh, when you look at valuation on a project, you take a look on, does it generate cash? Why? You could not rely on accounting standards for this discussion on finance. Why? Because accounting standards requires you to accrue something. So accrual of revenue is a debit to AR and a credit to revenue, right? And then if I do that, remember if I do a debit to AR, account receivable, which is a balance sheet account, and then a credit to revenue. So you might have an amount, right, on the books as revenue, but it doesn't mean that you receive the cash. Actually, a lot of fraud that happens on organization at year end, they would actually do a entry like this, and then the year after, they would actually provide an allowance. So what happens? Basically, they provide an allowance on the receivable as an expense to write off or provide allowance to receivable because you're not going to collect that. So those are fraudulent activities that been in most case studies you've seen that, and then a lot of folks would actually do complex transaction on that one. But for now, what we're trying to say is the most important one is that the cash flow generated by a company is more important than the accounting income. So this one is more important than accounting income. Why? Because cash flow or tangible cash generated by a project or the company in being valued. And how do we look at it? Let's do it an example. For example, so your profit and loss data, remember your income statement, you might end up with earnings before depreciation and taxes. This is similar to operating income before depreciation and taxes. It's the same. Let's say 20,000. So in order for us to do a cash flow recon, I would say I need to pay taxes because I need taxes you pay, right? So from these earnings, I need to deduct the taxes. But at the same time, I need to actually add depreciation back. Why? Because depreciation is really a non-cash expense. You when you record income tax, do you pay cash? Yes. because eventually you would pay cash because you need to pay the IRS, right? Or your revenue regulation or authority. Now, for depreciation, it's just the recognition of an operational expense, but it's non-cash. But at the same time, in order for you to arrive at the tax amount, you need to deduct depreciation because depreciation is a deductible expense, but a non-cash expense, right? Why is it a non-cash? Did you pay cash to recognize depreciation? Not really. You recognize depreciation because you invested on an asset before. It might be at the beginning of the year, it might be a few years back, but that was at one time. You bought fixed asset. That's your cash outflow. But depreciation is a non-cash expense. So wanted to make sure that that distinction sits well with everybody, right? Now, we have two layers, right? And I'll explain it again. From the earnings before, operative words before, I will deduct the depreciation expense. So from 20,000 minus the 5,000, hypothetical. So you now have 15,000 as earnings before taxes. And then your taxes, assuming it's 25% of earnings before tax. So it's 3,750. How did we do that? Let me go here, press F2. Basically, F17, which is actually the earnings before tax, multiplied by 25%. So that's actually your 3,750. At the same time, in order for me to calculate the earnings after tax, I now need to deduct from 15,000, the 3,750. So if I deduct that, earnings after tax, after, is now 11,250. You can see it that way, okay? So I add back, that's why I have an arrow here, right? So I add back to this side the 5,000, which is your depreciation. Why? In order for us to calculate how much taxes we need to pay, cash outflow, I need to consider depreciation. But I need to add back depreciation to arrive at the cash flow because depreciation is a non-cash expense. So now it's actually, we did not make, so accounting income, when you think about it, it's actually 11,250. But your cash flow is higher than your accounting income, which is 16,250. Now, so somebody would say, okay, I kind of get it, but can you give me one more example? Just in case, the same example right here. What if the company has an income before depreciation and taxes of 20,000, and then let's increase this depreciation, to the same amount, 20,000. So it would look like this. Income before taxes and depreciation is 20,000. Then I will deduct also depreciation expense in order for me to compute earnings before taxes as the base to compute the 25% tax. Of course, I don't have an amount because 20 as income before taxes and depreciation minus the depreciation of 20, 0. You don't have a taxable income, so I don't have taxes. At the same time, you don't have earnings after taxes. So your accounting income, when you think about it, the accounting income is actually this. So now would you believe me when I say, hey, how much is your accounting income? Basically 0. Oh, it's not synonymous that you did not have any cash flow. Why? Cash flow, when you compute it, you need to add back the 20,000. So technically, for the same company, which is an increase in depreciation, max at 20 for this example on the right side, same company, right? You generated really cash flow of 20,000. It's just so happened that you don't have any profitability or you don't have any accounting income, right? So that's why it's always important to reconcile your your net income, your accounting income, to your cash flow. For accountants doing accounting, accounting income is important. I'll just use the term accounting income, right? Or accounting, basically. But for us in finance, we actually look at valuation of the business, of an investment, of a project. So we always follow the cash. Okay, so something as a frame of mind, we're looking at this one. Now, that's one example. That's the reason why we know we need to do cash flow. Okay, so I'm going to now go through step number two. Now that we understood what is cash flow and accounting income, and we know that we need to focus on the cash flow, we will give you a calculation on NPV and then IRR. Actually, I'm going to show you also um, the payback period, but on the later part, okay? Because this tab does not have the payback, so I'm going to do a payback period calculation after this video. We will now go through a investment. So we understand cash flow is important, but let's give more examples. I have two investments. Let's make it a different color. Investment A and investment B. Investment A, so I'll do first with A. Investment A, your cash outflow is 10,000 on year zero. So we always say year zero is actually the now. Year one is 1 year after. So always think about it that way, right? So year zero is the now, and then year one is 1 year after now. That's how we look at it when we do time value of money, right? So at year zero, or the now, you will spend for investment A 10,000. And then for the next 3 years, the investment of 10,000 will give you back 5,000 in year one, after year one, 2,000 or 5,000 after year two. So that's 10,000, and then another 2,000 in year three. So that's 12,000. So your 10,000 on year zero will generate in the next 3 years a total cash inflow of 12,000. Year after year one, 5,000. After year two, 5,000 again, and after year three, 2,000. Now, investment B is 10,000 as well, but it will give you smaller amounts, but it would last for 5 years. 1,500 after year one, 2,000 after year two, 2,500 in year three. Then now you pick up the 5,000 and then 5,000. Question is, we know that you need to discount it. These are future values, right? And I need to discount that to the now in order for me to see what's the value. So what are we trying to do? Just to give you a big picture. So we normally call this one your hyper focus. You zoom in, right? But we want to zoom out, to step back and take a look on the bigger picture. I'm going to invest 10,000 on year zero, the now. In the future, I would have this. I wanted to know if I discounted each one and summed it up on year zero. Basically, that's what I'm trying to do, right? Each one, I'm going to use a present value factor. And then I'm going to bring it back to year one, or year zero. If I add back, are the present value of the cash inflow, what are the cash inflow? These are the cash inflow. Are the present value of the future cash inflow will be higher compared to the cash outflow. Makes sense, right? So accounting and finance should always make sense as a business. We just want to make sure that we explain the logic or the calculation, or we don't just dive into the calculation, then nobody understands it anymore, right? What's the reasoning behind? I would like to know and compare the present value of the future cash flows for how many years and bring it back to year zero, wherein you're going to spend it. So now it's going to be apples to apples comparison. Year zero, 10,000. I have future cash flows, inflow, because it's receipt income. So let me discount it to the now. And then if your cash inflow as aggregated and discounted, or as discounted and aggregated, is higher than your cash outflow, then I would say choose the one with the highest net present value. Basically, that's what it is. So let's make sure that we read through some of the theory, right? What's a net present value? Net present value is a method used to determine whether an investment or a project will make or lose money by calculating the present value of the future cash flows, both incoming and outgoing, um, the project will generate. So, in simple terms, net present value tells you how much profit or loss you will make as an investment after considering the time value of money. So, why do you call it net? Because the positive, cash inflow, you do the present value, then the negative, the cash outflow, you net it out with the present value of the cash inflow as discounted. That's why it's net present value. Now, of course, on the net present value, so here, investment A is actually this one. Investment B is this one. So I kept the color coding. So 5, 5, and 2 is the same. 5, 5, and 2. Year 1, 2, 3. Here's all year 5 on investment B, year 5. And then the information here are carried over here. Okay. Cash flow in are positive, then out are negative. Okay. And then here, I have a present value factor, which we talked about how to calculate in your the long method, right? In your week number 7 on cost of capital, even before that, right? And then if I have A, cash flow, then multiplied by B, the present value factor, using this formula, and then I represents this rate, and I multiply it, I will get the present value, then I'll add it up. Now, let me make sure that we see the formula, right? How we create it. So I would have the year, so this is year 0, and then I would normally do a +1. So it's easier for you if you drag down. So if I drag this down, for example, I'll delete it, okay? If I delete it, the numbers change. Why? Because the numbers, I actually have a formula already. So this one is actually H11 plus 1. If I drag it down, it would mean that it would copy it, 2 and 3. The formula is 1 over 1 plus I. I is J8, which is 10%. And then we put dollar values before and after the letter. So it means that it's an absolute reference. It would always be following that anchored value, which is 10%. Also, one thing that you want to see is that I am actually doing the caret and H11. So H11, H, then 11, basically is the number of years. So that's why it's important to get that calculation. So if I do that, or that years, right? The one that we did plus 1 year. So if I do that, I do that, I do that. Okay. And then we multiply it. So of course, this one will be 1 or 1 or times 100%, right? Or 1. Why? Because it's actually year 0. So it would actually invalidate it and it will return to 1. So $1 after 1 year. So here's how we read this one, right? $1 after 1 year at a discount rate of 10% would only be 91 cents. Something to think about. $1 after year 2 using a discount rate or weighted average cost of capital of 10% is 83 cents to $1 because that's the time value of money. In our case, our multiplier is 0.91, point something, 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 because this one is a long number, right? So I'm just making it 2 decimal places. And then if you multiply it, that would now represent your cash inflow and cash outflow valued to the now. So that's why I just need to add it up. Similars also to investment letter B. Okay. Simple enough, right? But of course, there's an Excel function that we would want to make sure we know also, because if there is a shortcut, why not use the shortcut also? But representation wise or representing it is also important. Let me just copy this. So the formula is equals to NPV, net present value. The first is actually the number, which is actually the discount rate. And then after the discount rate, this one in red and two are your cash inflow, close it, plus your cash outflow. So that's the syntax, right? So I'll do it again. Equals net present value. You can see that one. So open parentheses, rate. What's the rate? 10%. Comma. It's going to ask me values 1, 2, 3, or whatever. It will only be the cash inflow. Only the cash inflow. Why? Because you have now the 1, 2, 3 as years, right? And then, but I need to bring everybody or everything, the cash outflow plus the cash outflow on a negative number, on a negative number to year zero. That's why you don't include that on altogether as a formula. I'll show you the wrong way. Here's the wrong way, right? So, the wrong way. So the wrong way don't do is do this one, NPV, and then I'll do rate, and then I'll do that. It's wrong, right? So if I do that, it's 163, does not even tie up with our manual calculation. So this is actually wrong, bad, right? So I'll delete it. Now, we do the same thing for the net present value with regard to investment B. So looking at it, which one would give you the highest present value? It's letter B. Okay, so it's letter B. And then what's the rule now? Only on the net present value. So we'll do it one by one. The rule is that if the net present value is greater than zero, accept. So this one is acceptable. This one is acceptable as a project. But if the net present value is less than zero, then reject it. Don't do it, right? Now, at the same time, here's a question to everybody. You have, say, $10,000. We'll just say it's in $10,000, not 10 million. $10,000 you're going to invest on A. After 3 years, it's going to give you only $180. Might not be a good investment. That's how you read through it. And then here, it's actually the same 10,000 that you're going to use for the same interest rate or discount rate. But for 5 years, you're going to get 1,414. So $180 for 3 years, but you need to wait for 2 more years to get 1,418 or 414. So it might be too long, right? So $10,000 is actually too small, right? That amount of 1,414. So when you think about it, look for a project that will give you the highest one. Maybe there's investment C, investment D that might generate a higher net present value. Then use that one. Okay, that's why you actually compute. Why? Question is, what if you only have $10,000? Then I would choose investment B. If I have $20,000 and there are no other projects that I can invest on, I might want to fund investment B for 10,000, investment A for 180 net present value. Why? Here's a qualitative thing that you need to think about. It might be bad because it's only 180 for 3 years, but as you, CFO, as a manager or as a director, and then you talk to your COO, you can actually do a lot within the next 3 years, maybe to make the profitability or the net present value higher as you go through the years, because that's now your strategy. Right now, what you're trying to do is call it quantitatively calculating how you allocate your capital and which investment you need to fund it. If you only have 10,000, then fund B. If you have 10,000 or 20,000, fund B and A, right? So because this one will actually give you 180. So what if you say, what if I fund B for 10,000? It will give me this much for 5 years. And then the other 10,000, if you have 20,000, why don't I just put it on a bank account? And then I don't want to put a lot of effort. And then for 3 years, it's going to be 180 only. But remember, your discount rate that you're using is 10%. Your bank account might only be giving you 5% interest, right? So those are the qualitative things that you need to consider. Now, you know that it's not enough looking at NPV. So that's why in any capital budgeting decision, we need to consider also another one, which is the IRR. Okay, so the IRR, I'll go here on the third tab. It's the same project, it's the same investment that we have. So we're now going to do a step 3, right? And I'm highlighting now here the IRR instead of the net present value. So the IRR, or internal rate of return, is the percentage that tells you how profitable an investment or project is. It's the rate that makes the net present value of all cash flow from the project equal to zero. I know it's a technical term or definition, but we will actually explain that later with a simulation. In simple terms, IRR is the break-even rate for the return on the investment. What's the rule? The IRR should be greater than the discount rate in order for you to spot a project that has that you would want to invest. You can tell already just by looking at this one, the IRR on project B is higher than the discount rate by 4.33. The investment A, the IRR is only higher to the discount rate by 1.16. Let me paraphrase it again. The rate of return, so your cost of capital is 10%. So you're expecting that anything that you would get is actually at 10%. You use it, right? That's the weighted average cost of capital, the expectation from the equity investors, and then the cost of you getting debt or issuing debt. Anything higher than the debt discount rate or that weighted average cost of capital, this discount rate, is actually a good thing. So this one's 11.16 compared to 10. Good. This one is better because it's 14.33 compared to 10%. Now, how do we calculate it? It's actually a simple formula. IRR is equals to basically cash inflow and outflow, no consideration whatsoever. You just add it all up. You don't even include anything else. It's just the straight up negative and positive. So what's the wrong way of doing it? Sometimes I've seen some students who might have a present value calculation. You might do it this way, it's wrong. Why? See, it's 1%. Why? Because you're using the present value already. It's been discounted already. So it should be the undiscounted. It should be this one. If I enter, it's 11.16. Now, how do I know that this is true? It's the rate, IRR, that will make the net present value of all cash flow from the project equal to zero. So let's do it this way. What is the formula for each one? I use J8, J, and then number 8, which is actually the 10%, right? So I use that one. What if I just link it out equals? I link it out to 11.16. What happens? It returned it to 0. Okay. So it's the rate that makes the net present value of the cash flow break even to 0. So it's 11%. So you know that your IRR is good if you do it that way. That's normally what we do at work also as a final check. I'll link it up, 0. I'll undo just to be sure. And then that's the IRR. So each of the tab, I would include a screenshot of the formula. So at least it will guide you, right? And then it would show you. Of course, you can always go back to the Excel file that I will be posting and press F2. Okay. And then you would actually see it. There you go. So on the IRR, I'm going to go here on the IRR. What's the take on this? The higher the IRR, the better. In this case, it's this one. And then I'll play with it. So let me play with this one. So what if, just in case, this is 1,000 only, this is 500, this is 500. So sometimes your IRR can be negative 20.8. You don't want that because your IRR should be higher than your discount rate. When you think about it, it's like this. Your discount rate is 10%. Anything above 10% is a good IRR. So it might go to here, which is 0%. But the IRR that we have right now is 20.18, is actually here on your scale, 20.88% negative. So you don't want that. You want it above the range. Okay. I just wanted to show you that for simulation purposes, but let me undo. So it goes back to 14.33. Okay. So hopefully you're seeing the calculations and whatnot. So last one for this video on this calculation is that you now need to take a look at the modified internal rate of return. So the MIRR is actually a variation of the IRR. Why? The expectation is that, so the amount that you receive each year, oh, let me move it out, right? The amount that you receive each year, which is this one, the 5,000, 5,000, 2,000, or the other investment, this one, you are expecting that you will be investing it on a discount rate of 10% to come up with the net present value, correct? Now, some of you will be able to invest it on the discount rate. Some of you might be able to invest it on the internal rate of return of 11.16. But depending on the economy, your economy might not be able to get 11.16 as a profit, a profitable business during that time. Because your investment is either through your cost of capital or your IRR. But of course, we know that that's a bit unrealistic, right? You could not be one or the other. It can be one or the other, depending on the economy, because these are estimates. So the variation is actually the modified IRR, which is a variation of the IRR that fixes the limitation of the IRR. So the IRR assumes that all future cash flows are reinvested at the same rate as the IRR. So all the future cash flows are reinvested at 11.16 or 14.33. But the MIRR gives you a realistic estimate, assuming that the cash flows are reinvested at the company's cost of capital. So because you might not realize this 11.16 for A or 14.33 for B. So that's why there's an MIRR. So the MIRR is actually, MIRR is the same section in blue. We would include everything as a range, but I need to show two numbers. Both are actually your discount rate. What do I mean by that? Equals MIRR. What's the values? And then the finance rate and reinvestment rate. The finance rate or the values, then I would actually complete that. You are thinking that your finance rate is 10%, and also your investment rate is 10%. So I highlight it. Then that's your MIRR. Because why? You're assuming that the cash flows are reinvested at the company's cost of capital or something that you choose. But right now, we will use it for MIRR calculation at 10% or your discount rate. So not too bad. It's actually easy also as well. And then when you go down, you would actually see that. So here, it is MIRR. So let me just modify that one. The higher the MIRR, the better. That's the rule. Now, I will go to a next slide to talk about payback period. And also we will go to the other slide, to the other deck. We would actually go through the evaluation calculation. So we might end up with three video, but the payback going to be a small one. So for now, we'll end this calculation and then we'll go to another one for the payback period. Okay, thank you everyone.